There's panic at the White House and a shakeup at the Fed. All that and more on today's show. I'm your host, Steve Van Metre, and thanks for joining me today because inflation is surging higher, and that's bad news for the White House. In fact, for any president, one of the worst things they could have happen is high and rising inflation. It's bad news not only politically, but economically. Let me show you why. We'll hit to this headline here that Biden starts to freak out about soaring inflation, orders his economic council to reduce energy costs. Now that's interesting, talks about energy, because we've talked about that before. I'm going to show you why this is such a big deal. When discussing today's shock, this from Zero Hedge CPI report, we said it was just a matter of time before there's a wave of political blowback that will make recent anti-democrat revulsion in Virginia and New Jersey seem like amateur hour. Now, there's a reason they make this comment, because from a political standpoint, when you have high inflation and wages aren't rising fast enough to meet it, which we're going to look at, people tend to not like it. When their wages are declining or prices are rising faster than their wages and their standard of living goes down, well, they tend to do something about that, and usually it's at elections. Let's continue on with this. So specifically, we said that, quote, the explosive inflation surge threatens to exacerbate political challenges for President Biden as he seeks to pass a nearly $2 trillion tax and spending package and defend razor-thin congressional majorities in next year's midterm elections. And that is true, because here is the CPI print from today. You can see month over month, just lights out higher at 0.9%. This is, even the experts were predicting 0.6, and this blew way past that, bringing the year-over-year rate of change up to 6.2. Even if you strip out food and energy, you still had a blistering hot 0.6%, and this year-over-year up to 4.6. So consumers are really getting hammered here, and they're not liking it. And let's take a look at why as we look at the charts to see that inflation is the highest it's been since 1990. It's just off the charts. That not only is the pandemic, the supply chain issues, but we've got higher food prices, higher energy prices, higher shelter prices, and it's impacting everybody across the board. Doesn't matter, rich or poor, everybody is feeling this, and you can just see it's just way off the charts. There, red is the year-over-year CPI, and in green is the core. And normally you do not see the core CPI surge like that. Usually it's fairly stable. It doesn't go vertical like this. You will see the CPI do that. But there's one thing to think about. When you do see a big move higher in the CPI, oftentimes people believe that higher prices beget higher prices. Well, sometimes they peak and lead to lower prices if they're rejected. And this is something we've talked about on the show many times, is real earnings. And when you see real here, I want you to swap that word out for inflation adjusted earnings month over month, minus 0.9%. So what does that mean? When it comes after adjusting for inflation, workers had less money. They made less money. And if you make less money due to inflation, what does that mean for your spending power? It means that you can either you spend less because you have less money, or you're forced to balance that by taking on more debt. And that is a challenge, because the question then becomes, if consumers are willing to take on more debt because they believe their wages are going to rise and they're going to pass inflation, how long are they willing to do that? But when you get big prints like this at minus 0.9% month over month, well, consumers are going to get discouraged pretty quick. Let's continue on with this story, because here you can see U.S. real or inflation adjusted average weekly earnings going back to 1982. Using 1982 to 1984 U.S. dollar year over year, seasonally adjusted. What do we see? Negative 1.6% year over year. So what does that actually mean? It means if you go back a year from now, earnings due to inflation have actually gone down 1.6%. So even if your wages have increased from this time last year, consumer prices have increased so much more that you cannot buy the same things you did a year ago. You have less spending power, and consumers Well, they really don't like that. And when we talk about consumers rejecting higher prices, that's where you see it in that real average hourly earnings or weekly earnings, because they don't have the money to buy goods and services at the same pace, same standard they used to. So if you don't have enough money to do what you used to do, what does that mean for goods and services that are sitting on shelves? They're going to sit there longer. And that ultimately means manufacturers, wholesalers, retailers will be forced to eventually lower prices to move that inventory, because guess what? They have debts, they have bills to pay, they have rents, they have employees, they have things they need money for, and they need those things moved off the shelf. And here you can see that gap when we look at consumer price index on a year-over-year basis in blue versus average weekly earnings. And you remember back during the pandemic, there was all this spending and all this money that was being spent out in the economy, and people were talking about pent-up demand and how the economy was just going to surge forward. And I want you to take a look at this, because what you see is how much weekly earnings were moving above consumer price index. You can see at one point they were over 7%, and at that point the CPI was only around 4.5%. So consumers had more money to spend, and they did. But how about now? You can see that average weekly earnings around 4.5%, and we know the CPI just went over 6%, and that tells us that consumers cannot afford higher prices, and therefore they will be rejected. It is not a matter of if, it is a matter of fact. They will reject those higher prices, because at some point they will stop charging the difference when they feel like they can't catch up, and they will have to cut their debt load. Let's continue on, because what you can see here on inflation, today's report shows an increase over last month. Very clearly it did. Inflation hurts Americans' pocketbooks, and reversing this trend is a top priority for me. This is from President Biden. The largest share of the increase in prices in this report is due to rising energy costs, and in the few days since the data for this report were collected, the price for natural gas has fallen. Quote, I have directed my National Economic Council to pursue means to try to further reduce these costs, and have asked the Federal Trade Commission to strike back at any market manipulation or price gouging in this sector. He's referring to the energy sector, because energy is a big factor in consumer prices, and the Biden administration knows that, and they need to get that under control. So you already know that, because if you've been watching the show, we talk about how the consumer price index and energy prices, crude oil specifically, well, they have a nice relationship. And here you can see that crude oil in red on a year-over-year basis is starting to decline and come down. And ideally for the Biden administration, they really want to get this in control. As I mentioned, from a political standpoint, people tend to vote out politicians when their standard of living goes down. This is just a matter of historic fact. It does not matter whether you're a Republican, Democrat, or independent. When standard of livings go down, change happens. And here you can see the consumer price index going up. And we've seen in the past when the consumer price is rising and crude oil starts falling on a year-over-year basis, and we discussed on Monday that the year-over-year comp should start to slow down due to the rate of increase in crude prices from a year ago continuing to rise. You can see that inflation can be sticky and sit up there a little bit. And why is that? I want you to ask why, because the answer is inflation is a lagging indicator. It's a look back indicator. Now, oftentimes people see it as a leading indicator. It is not. It is a lagging indicator. So crude is already telling us that inflation should start to cool off. But boy, today's report, huge surprise. I didn't think it was going to be anything close. I thought it was going to be unchanged. That was my prediction. And boy, I was way off on that. But here we can see why the Biden administration is focusing on the energy sector, because here are the percentage changes in the CPI for all urban consumers. And what do we see? Energy sector. I mean, the numbers are big. You look at food up 5.3%. I mean, that's a lot, right? I mean, that's no small number. You can see down here, commodities, less food and energy up 8.4, new vehicles 9.8, apparel 4.3, shelter is up 3.5. But look at energy. 30% year-over-year increase. How about gasoline? 50% year-over-year. How about piped gas service? Up 28% year-over-year. Used cars and trucks up 26%. So if the Biden administration can get control of the energy part of this somehow, that would go a long way to easing the stress on consumer pocketbooks. But can they do that? Well, that is the big question. And we can see that crude oil stocks sitting at Cushing, look at Cushing, Oklahoma, the weekly in millions of barrels. Well, it's already at a pretty low level. So it's not like there's much to play with there in terms of getting crude out of Cushing. But how about this? We now have heard that presidents, well, we know President Biden is looking at the Strategic Petroleum Reserve. And let's take a look at how they use that to ease stresses in inflation. As U.S. President Joe Biden is rarely used, but potentially powerful tool to make up for supply shortages or economically damaging price spikes. There you go. The Strategic Petroleum Reserve, set up in the aftermath of the Arab oil embargo in the 1970s as a national energy safety net, is the world's largest supply of emergency crude stored in deep and heavily guarded underground salt caverns along the U.S. Gulf Coast. Now, I know this for a fact because I have many clients in the oil and gas industry, and they tell me there is plenty of oil. And sure enough, how much oil is in reserve? The reserve stood at 612.5 million barrels as of October 29, enough to replace more than half a year's worth of U.S. crude net imports. That's about 86% of its maximum authorized storage capacity of 714 million barrels. So one of the questions then becomes is, will President Biden use his powers and pull crude out of the strategic reserve to ease prices? Now, in the short term, he has sidestepped this a little bit, but he's getting pressured to do something by his own party. As you can see here, Democrats press Biden to consider oil export ban. Wow, can you imagine banning oil exports and a Strategic Petroleum Reserve release? How about that? Here you can see President Joe Biden faces growing pressure from fellow Democrats to address rising gasoline prices by taking steps that include a possible ban on oil exports and the release of crude from the nation's strategic reserves. 11 Democratic senators, including several known for their concerns on climate change, urged Biden in a letter this week to act quickly when the national average price for a gallon of gasoline is highest level since 2014. The senators invoked the undue burden on families and small businesses and pressed for the release of oil from the nation's strategic reserve, or even more, the more drastic step of banning the export of U.S. crude. And again, this becomes a political issue here so far, but I haven't shown you the economic damage that comes from this. But let's talk about still the political aspect. So you're seeing not only is the White House worried about it, but you're seeing senators, congressmen, congresswomen, they're getting worried because if your seat is coming up for election and you've got high prices and your constituents cannot afford them, well, you can tell they're going to blame somebody, even if it wasn't directly your fault. Well, they're going to go to the ballot and generally make a change. And that is very risky given the thin majority the Democrats have going into the midterms. So it's likely we'll see something here, but let's continue on because prices for inflation are likely to continue to go higher. We look at shelter and rent inflation on a year-over-year basis, and what do you see? Shelter inflation is rising. That means we know home prices are rising, and if you own a home that you're renting out, well, what do you do when the price goes up? You raise your rent. And so rent inflation is expected to go higher, and since the three key things that consumers have to deal with are rent inflation, energy inflation, and food inflation. And what do we look at? Well, food inflation is running over 5% a year. Energy is at 30% a year. And well, let's see where shelter inflation is at. It's at about 2.5% and projected to go over 3.5%, maybe even higher, depending on where shelter inflation goes. What does that tell you? Consumers are going to get pinched really hard. And that's a problem because, well, there's a lot of debt. You see household debt and credit report here from the Fed. New extensions of credit help drive total debt over $15 trillion because that is a good thing, right? According to the latest quarterly report on household debt and credit, total household debt increased by $286 billion or 1.9% to $15.24 trillion in the third quarter of 2021. Mortgage balances, the largest component of household debt, rose by $230 $30 billion. Auto loans increased by $28 billion. Student loan balances grew by $14 billion, coinciding with the start of the academic year. Credit card balances increased in the third quarter by $17 billion after an increase of the same size in the second quarter. Non-housing balances grew by $61 billion with gains across all types of debt. And here you can see non-housing debt, all-time high, housing debt, all-time high. And it's a problem because, when you start understanding the household balance sheet issue and why this is damaging for economies and leads to slower growth, leads to disinflation, leads to deflation, is when your spending power shrinks and you've got high energy prices, high food prices, high shelter prices, and a lot of debt. Well, that leaves very little money to spend out in the real economy, and that's where you get the driver of inflation. So this is a huge problem because if paychecks continue to shrink, consumers are going to be forced to spend less. And there may be some problems facing them this winter because natural gas exports lift prices for U.S. utilities ahead of winter. This is going to blow you away, my friends, when you see what this has to say. The supply squeeze, one of the first ever since the U.S. began sending, get this, large volumes of gas abroad, means hefty heating bills for consumers. That's right, your heating bills are going up if you use natural gas. And we talked about this in a previous show. American utilities are facing the highest natural gas prices in years as they build stockpiles for the winter. The reason, you're not going to like this, exporters are sending more gas than ever to countries starved for fuel. That's right, we're sending our gas out of the U.S. to other countries, and your bill is going to go up. My bill's going to go up because of that. That doesn't probably make us all feel too good. Pipelines to Mexico and Canada and tankers traveling to Europe and Asia have moved record amounts of U.S. gas out of the country this year as parts of the world fall short of supplies. American frackers, meanwhile, are holding the line on new drilling as investors pressure them to maintain capital discipline and return money to shareholders. But maybe there is some help coming from President Biden and his administration because Toyota, Nissan, and General Motors are jumping start of production as chip crunch eases. They're going to increase a number of vehicles they build substantially. Here we can just see Toyota and Nissan are among global automakers that plan to ramp up output in the near term, sharply reversing course on recent production cuts caused by chip shortages. This will help bring people back to work and take some heat off of rising car prices. And how about now a record 111 container ships floating off California's coast waiting to be unloaded Tuesday. Wow, that is just crazy. And here you can see that one of the issues people have with inflation is they wrongly believe that rising consumer prices lead to higher treasury yields. And as we talked about on Twitter this morning, is that those who know, and that's not many, realize that higher prices actually lead to lower interest rates. And why is that? Because people can't afford those higher prices. Interest rates need to go down to create money to get people to borrow to pay those higher prices. Check out the chart. Now, I know in the past, this is what people looked at. They said, oh, look, consumer prices went up and then interest rates went up, and consumer prices go up and interest rates go up. But that dynamic has changed. And now you can see consumer prices going up here in the great financial crisis, and what happened led to lower yields. Here you can see around 2011, consumer prices rising, lower yields, consumer prices rising, yields meandering and then heading lower, consumer prices rising, everyone betting that interest rates go up. The more likely direction for interest rates is down, not up, not up at all. The big risk for consumer prices is the dollar. If the dollar gains steam, and we talked about this due to the largely inverse relationship between the dollar and consumer prices, if the dollar can move higher, well, President Biden is going to get a big relief from higher consumer prices. And how about this? Here you can see the economic damage by rising consumer prices, and you see here real gross domestic product, both shown on a year-over-year basis. Consumer prices rising, there goes output down, GDP down, prices rising, down, and you can see that every time, because we're looking at real gross domestic product, inflation adjusted, that when inflation kicks off, what happens to GDP growth? It goes down, and that is the other side of the story. It's not just political, It's economic. And from an unemployment perspective, you've also got an issue here because initial claims this week came in at 267,000. Now, granted, they're slowing, but if prices are rising, what do you think is going to happen with businesses when consumers start rejecting those higher prices because they don't have the money to spend? Well, those businesses that added on staff, what do you think they're going to do? They're going to send them home back on the unemployment line. So the serious issue then becomes, well, what about the Treasury auction day? The 30-year auction was terrible, and we saw yields spiking and then coming back down and moving all over the place. What's the issue here? And when you look at these Treasury auctions, a lot of people use them as a barometer for demand, and that is not really how you should look at them. Now, I, for one, will admittedly say I love to celebrate a good auction because it's usually beneficial as the bond king, but they really don't matter that much in the big scheme of things, because when you look at these auctions, all it's telling you is the global economy is either functioning properly or not. And when you see a strong auction, it tells you that the global economy is functioning well. That means dollars are leaving the United States, getting into foreign countries, and then the foreign countries, the central banks, are using those dollars to buy Treasury securities to tamper the inflationary effects of having dollars in their economy. So when the cycle is working, we should see decent foreign demand at every auction. That's how the system works. So when you start to see problems, it doesn't mean people are rejecting U.S. debt. It just means there's problems in the global economy and the global trade cycle. Well, when you've got 111 ships sitting off the coast of California, for one, that are importing goods that are going to then turn around when they get paid for those goods, exports dollars, you can see why this little hiccup in today's auction really doesn't matter that much. And I'll show you why. Because when you look at federal debt held by foreign and international investors, well, it tends to rise. And while the market makes a big deal out of, well, how many people, what the bids were, and all those little things, what matters is when you overlay 10-year Treasury securities and you invert federal debt or federal debt held by foreign and international investors, as foreign and international investors take on more U.S. debt, regardless if the auction is good or bad, as long as they take on more debt, where do you think the trend for yields should go? And that, my friends, is by design of our financial system. So let's quickly talk about what's going on at the Fed, because there's a potential huge shakeup coming, and people, I think, are misreading what's happening. And we see here Quarles exit the Fed at year end, handing another seat to Biden. Well, he was expected to leave anyway, so that wasn't it. And the big talk is Brainerd interviewed by Biden for the Fed chair as the search heats up. And here we see Federal Reserve Governor Lael Brainerd was interviewed for the top job at the U.S. Central Bank when she visited the White House last week, according to people familiar with the discussions, signaling that Chair Jerome Powell has a serious rival as President Joe Biden considers who will lead the Fed for the next 4 years. Powell and Brainerd are the only two people who have publicly serviced as being in the running for the chair, mainly because Powell has not resigned or announced that he was going to step down. Powell's current term ends on November 2nd. Or no, not November 2nd. Biden said he would then announce something shortly after November 2nd, and as Powell's term is soon to come to an end. And the decision in favor of Brainerd would suggest a dollar negative yields lower. Well, but what is the real issue here is not with what's going to happen to yields. The issue is the Biden administration will have a huge opportunity to put multiple people on the Federal Open Market Committee. Now, just because he nominates someone doesn't mean Congress is going to sign off on them. But the view is if Brainerd takes over the head of the Fed, that she's going to print a lot of money, do a lot of QE, and we're going to be on the path to modern monetary theory. Well, I want to challenge that line of thinking, because when you get a consumer prices this high, guess what they're not going to do? Not more QE, because guess what they think? They think QE is part of the problem, and that means you don't have to worry. Even if Brainerd takes a post, probably is not going to reverse the policies that Powell has laid in place about unwinding their balance sheet. It's a dangerous game, because high inflation also tends, like we talked about, to lead to people being voted out of office. Thanks for watching. As always, I'm Steve Van Metre. Appreciate you being a fan. Appreciate you subscribing, liking the show, supporting it. We'll be back on Friday. The content of this video is provides educational information only. It's not intended to provide investor or other advice. It is not to be construed as a recommendation or solicitation by a security, financial instrument, or to participate in particular trading strategy. This video was prepared by Steven Van Metre personal capacity. Opinions expressed in this video that do not reflect the view of Atlas Financial Advisors Inc. or Steven Van Metre Financial.